Good morning, everyone. This is Marshall Gittler bringing you the morning comment for March 25th. Well, euro-dollar moved higher once again, confounding those of us who expected to see parity within a matter of days. But once again, 110 seems to be the new upper limit for the pair. It broke through there briefly after the U.S. CPI data came slightly stronger than expected, which should have been dollars positive in my view. Moreover, U.S. new home sales were better than expected, and the market PMI surprised on the upside. Nonetheless, Fed funds rate expectations continue to decline. It looks to me like the better-than-expected data, if it continues, should change attitudes towards the Fed and start supporting the dollar. I have to admit, though, that there are some good reasons why the dollar has retreated from its recent peak. The recent low for euro-dollar was in the early hours of Monday, March 16th. Since then, the implied yield on the Fed funds rate contract has fallen. End 2016 rate contract has taken out about one implied rate hike, and the U.S. Treasury Bund spread has come in considerably as the market unwinds some of its expectations of Fed tightening. Nonetheless, I still assume that the U.S. rate advantage over Europe is going to draw in investors over time. As quantitative easing proceeds, Eurozone rates are only going lower, while U.S. rates seem likely to drift higher as U.S. inflation edges up. Now, the Swiss franc was the big winner yesterday without any major news to send the currency higher. Euro-Swissy fell below the 105-108 range it's been trading in since mid-February. It seems that market participants are beginning to think that with 3-month Swiss franc LIBOR already at minus 0.8%, the Swiss National Bank has precious little room to lower rates further. I expect the market to continue to test the downside for Euro-Swiss, which in today's context probably also means testing the downside for dollar-Swissy too. Yesterday's inventory statistics from the American Petroleum Institute apparently showed yet another big rise in oil stocks, but WTI was up slightly on the day, perhaps because of the all-around positive PMI figures, except of course for China. Oil seems like it could be vulnerable to tonight's release of the U.S. Department of Energy's more comprehensive inventory figures. As for today's highlights, we've got a relatively quiet schedule today. In Europe, the spotlight will be on the German IFO survey for March. All three indices are expected to have risen. Following the encouraging ZEW survey released last week and the strong German PMI data released on Tuesday, this could support the growing confidence that Europe's largest economy is gathering steam again. In Sweden, we get the economic tendency survey for March. A strong figure there could prove positive for the Swedish krona. In the U.S., durable goods for February are coming out. The headline figure is expected to decelerate from the previous month, while durable goods excluding transportation equipment is estimated to have accelerated. The market's likely to pay more attention to the latter core figure, meaning that the dollar could strengthen somewhat.